Most of you would have heard the expression, if it ain't broke, then don't fix it, which interpreted means something along the lines of, leave it alone, avoid attempting to fix, correct or improve what is already sufficient. We all understand this expression and would see this as a common sense approach to take in life. Why is it then that so many investors, me included by the way, don't adopt this approach when it comes to investing in index funds? When one fund has been designed to do the job in returning the market performance of the index it tracks, we like to tamper with things by adding extra ingredients such as other index funds in a belief that this will improve things. Passive index funds were first introduced by Vanguard in the 1970s, and index funds have consistently succeeded in accurately tracking an index and providing market returns that the index provides to investors. Therefore, the only reasons that I can think for our tinkering would be that we know better than the market. Maybe we're bored and we just want to experiment with our money. We have listened to one YouTube influencer too many. Or we do actually have a strategy that we think will work for us. This video is going to take a look at how index funds work and how owning more than one might be counterproductive or even expose you to increased risk in your portfolio. So let's firstly start at the beginning and consider what an index is. An index is a list of companies of various characteristics as defined by that index. You could say that an index is the club owner and that the companies are members of that club. To gain access to the club, you may have to be of a certain size, to be from a certain part of the world, to be from a certain sector, or be a certain asset class. Most indexes are structured in a way in which the larger the company you are, the bigger proportion of the index that you take. This is called market cap or market capitalization. Using that club analogy, the bigger the company you are, the higher up the pecking order you will be within a bigger seat. If you look at an index like a league table, then the bigger the company that you are, the nearer to the top of the league table you would be. If you find yourself nearer to the bottom of this table, you may face expulsion, as other companies with higher growth might seek to take your place, and that index will then adjust in line with market sentiment. Guess what? That index fund that you purchased to follow that index will do exactly the same thing and follow suit. So let's quickly look at what an index fund is. Passive index funds come in different forms, but two of the most popular are ETFs and mutual funds. We don't need to bother ourselves with the differences for the purposes of this video, but it is worth looking at the common objectives of these funds, and that is to accurately track an index and to provide a return to an investor almost identical to what the index returns. If we take a look at the FTSE All World Index, you will see that the top 10 companies in the world, all based in the US currently, account for approximately 90% of the index. And if you look at the countries and sectors, you'll see that the highest concentration is based in the US and that the largest sector is technology. This is the market telling us where growth and success currently lies. Any adjustments that the market then makes to this index would be replicated by those who are managing the fund. When you purchase, say, £1,000 of the FTSE All World Index Fund, you are purchasing just over 4% of Microsoft, the largest company in the index currently. This means that £40 of that £1,000 is invested in Microsoft. The remaining £960 is then shared out between the remaining companies within the index in line with market cap. So how do index funds benefit me as an investor? Well, let's firstly consider what your objectives are as an investor. Number 1, finding the best stocks to invest in. Number 2, making a reasonable return on your investment. Number 3, doing all this without taking on unwarranted risk. And number 4, keeping your stress levels low. If I were to take a route other than investing in a passive index fund and actively picking stocks for myself, how would I know what stocks are going to perform well in the future? I might look at the FTSE All World Index and buy shares in some or all of the top 10 companies as these are the best performers at the moment. But doing this would be using past performance as an indicator of future returns. And would I want to rely on historic data, given that there's no guarantee that the same companies will continue to grow and perform in the same way that they have done in the past? If you look at the differences between the top 10 companies in the S&P 500 and those that have been in the top 10 historically, you will see that there are vast differences. The current top 10 companies are therefore not necessarily going to be there in 10, 20 years' time. And if they are still in the S&P 500, they might be further down the table and out of the top 10. This tells us that past performance is not necessarily a good indicator of who we should be choosing to invest in the long run. Am I therefore going to put all my chips on one number once I think I've found something to back? If I do, then I run a very large risk of finding out that I'm wrong and losing some or all of my money. Some might be happy to take that risk by being more of an active investor, but for me, this is an unwarranted risk with my money. It would be nice though to have this magic chip that would cover all the numbers on that board, allowing me to hedge my bets and diversify. Passive index funds do exactly this as they diversify your investments across the index in line with market cap. Should one company do better, then this will be captured in the return of the fund, allowing you to benefit from that company's growth by giving you a reasonable return of all the good performing companies in that index. If certain companies don't do so well, then you should be protected by the ones that perform better to protect the value of your capital. This is diversity, and the diversity that passive index funds provide also protects you from market volatility across different regions in the world. The plan is that if one region or sector performs badly, then hopefully other sectors or regions will perform better, helping to maintain the value of your portfolio. Over time, the market then adjusts accordingly in line with market cap, and your fund replicates this. Diversification is probably the most powerful risk management tool that you have as an investor, as it prevents you from losing your money by not concentrating it all too narrowly within too few companies. This should help to keep your stress levels in check, as it will hopefully help reduce price volatility in your portfolio. Stress from price volatility is one of the main reasons why investors cash out, often realising losses in market lows, and often never to return to investing. Diverse passive index funds seem like a risk more worth taking in my opinion. So we talked about passive index funds and how they give you diversity to help manage the risk in your portfolio. Before we move on to the subject of this video, remember that expression at the start, if it ain't broke, don't fix it? That common sense approach to life that some of us seem to ignore. Let's talk about active funds. I used the word active earlier when talking about trying to find specific companies to invest in, and an active investor picks stocks, funds, or a combination of both in an effort to try and get the desired return. This surely must mean trying to beat the market, as why otherwise would you bother taking on additional risk when a passive fund would suffice and will just give you the market returns? I'm not saying that active investing is wrong, by the way, and you have to make your own choices on what investment strategy works for you, as active investing could bring you the return that you're seeking. What I will say though is that it's extremely hard to beat the market consistently. Amateur investors like me might try, but even the professional full-time experts will fail to do this consistently over longer periods of time. Active investing will often also come at an additional cost, especially if you're paying someone to pick stocks for you, but will definitely increase your risk regardless whether it's you or an expert picking the stocks. If you change the proportions of the benchmark index, then you do this for one reason, and that's to try and get better returns. You do not get that additional reward unless you take on additional risk. For an average investor like me, passive index funds are sufficient. If I invest in a passive index fund and then decide to invest in another one, for instance because of its past performance and fear of missing out, have I now started to drift from being a passive investor into being an active one? And am I now taking on more risk by changing the proportions of my portfolio to try and beat the market? Well, let's take a look at an illustration of this. If I invest in the Vanguard FTSE All-World Index, then I am investing in companies across all countries in the world. The index says that the correct weighting for companies in the US at the moment, given their size and value, is around 62%. And the top 10 companies in this index, all from the US, account for 19% at present, about 1/5 of the index, with our usual suspect on that list as you can see. If I want to add another fund to this portfolio, and I use the Vanguard S&P 500 ETF here, as this is what a lot of people tend to do given its good performance, am I now actively seeking better returns by increasing my exposure to the US? And in doing so, increasing risk by decreasing diversification, even though I'm still invested in passive index funds? Well, if you look at the companies in the S&P 500, the top 10 is almost identical to the top 10 that's in the FTSE All-World Index. But in the S&P 500, they now account for roughly 32% of the index. If I invest in these funds as a 50-50 split, I've now tilted my exposure towards the US with a bias of 82% and 27% being concentrated on those top 10 companies. By investing in both these funds, I caused overlap, where I'm investing in the same US companies twice and concentrating this exposure to fewer companies. This is fine if I'm confident that what I've aligned myself to will continue to do well. But as we discussed earlier, you cannot guarantee this from past performance, and my portfolio is now reduced hedging and diversity. As I increase my exposure to the US, something needs to reduce elsewhere, which means that I might miss out if other parts of the world, such as emerging markets, fare well over the next 10 to 20 years. Countries like China, India and Brazil form part of the emerging markets, so you might feel that it's sensible to maintain your portfolio proportions in line with market cap, but it's just reduced by you tilting more towards the US. I know that some of you out there will have combined these two funds together deliberately, and I've done this myself with the S&P 500 and another fund I'm invested in. I'm not saying this is wrong, but you just need to be aware of what you're doing when you combine two funds together and what the bigger picture is. Another issue that arises when you have more than one fund in your portfolio is that the proportions become more difficult to work out, even if it's a 50-50 split between two funds. This makes it harder to work out what part of your capital investment should go where, and makes it easier for you to make mistakes. These mistakes could be costly and lose you money. The one thing I should say here is that you're still likely to do well investing in passive index funds as one fund or in a multi-fund approach, and that the way that you decide to combine your funds might work better for you and might beat the market. If it does, well done to you. That said, there's a good chance that you would have done well or even better by just sticking with the market weighting and keeping things simple and less risky, but you won't know this until some time has passed and past performance can then be analysed. You could also unwittingly create an active portfolio whilst trying to be passive if you have different funds in different accounts. For instance, your SIPP may have different funds in different proportions to your ISA. Just because each of these accounts may have slightly different objectives does not mean that you look at them in isolation. Your portfolio is a culmination of all your accounts holding all of your funds trying to achieve the financial goals that you've set after all. Just food for thought. There are, however, times when adding funds to your portfolio increase diversity. This could be when you're adding something which maybe you don't already have. An example of this might be adding a bond fund to your equity funds. And you might do this because you're nearing retirement or you're a more cautious investor and you're looking to reduce price volatility in your portfolio. It has been found previously that equity and bond funds are negatively correlated. This means that as the price of one asset drops, the other will rise or won't drop as harshly. Whatever you decide to invest in, keeping things passive and diverse is a good way to keep the risk of investing in line with market expectations. Remember that if you add funds to your portfolio, you could be reducing diversity by concentrating your investments in fewer stocks, in fewer countries, in fewer sectors. And you could already be doing this if you have different accounts with different proportions of funds therein. That's not to say that active investing won't work for you, and it's for you to choose what you think is best. For me, as a passive investor, I want to make less choices over a longer period of time and, well, just hold what I invest in forever. This means that I will continue to trust what passive index funds are meant to do and let the markets decide in the long run. Well, I do hope that the content of this video has been helpful and useful today and that you'll consider hitting the like button. Also, I do hope that you consider subscribing to my channel and turning on notifications so that you know when new content's been posted. Once again, thanks very much for watching.